for the tax-savvy wealthy. And I'm Greg Jizmejian, insurance planning specialist here in Raymond James, and we've got with us Denise Leframbois. Before we get there, let's do the legal part, stating that these are just our opinions. We are not recommending anything specific for anyone listening in or any clients that later might listen in on this. But certainly some of the ideas are valuable and things that you should consider, and dialogue with a professional mortgage broker or investment advisor to pursue these ideas. And here are the two of us. So more important than the slides, I think I'm just going to unshare and we'll get the two of us on screen and have a conversation. So here we go. So Denise, thank you so much for joining us. Wonderful Wednesday noon. How are you feeling today? I'm
okay.
Awesome.
It's raining, so I don't regret being here instead of golfing, so we're good.
Oh, true. It is a rainy day out there. I rarely step out and look. Okay, so, just by background, I guess we should just mention that you have been a mortgage broker for some 6 years and have built up quite an expertise in the area, largely from your own trial and error. Apparently, you've learned along the way.
Which will come up in this, right? But yeah, I've been a mortgage broker for 6 years, in the top 2% of brokers in Canada for volume and number of units. So we definitely do a lot of mortgages. So not only do we learn things on our own, but also, from others. Some of the things we're going to talk about today too are things that we have special access to because we have bigger volume, because we do more. And I think that's part of the problem with a lot of people's clients is that, they walk into a bank and there may be something that fits them, but it might not be something that's presented initially because they don't know about these products or don't have access to them.
Perfect. Yeah. Well, I was introduced to you a little while ago, and I was just amazed at not just your knowledge, but the way you explain things. And I thought for sure my colleagues here at Raymond James and other clients should have an opportunity to meet you and hear what you have to say. And the topic we picked is something that I think is apropos for the kind of clientele we deal with here at Raymond James. And my leading question is going to be exactly that. You've got a typical client who has a paid off home. They might have a second property as well, and they have significant assets, obviously, that are managed here by our investment advisors. Why the heck would someone like that need any kind of lending?
Yeah, so what we see is typically things are getting referred to us either by a lawyer or by a realtor, and it's a situation of need, not a situation of want. So bad things happen. Right. I'm seeing a lot of it right now. I had 2 last week where the client's children went to buy a home. They were told the wrong amounts. They didn't get approved. And now this parent has to last minute get money to help their child. When we have to get money last minute because we have to help our kids, because there's a divorce or a death, they come to you as a financial planner and they're like, you know what, I need that money that's sitting there, and they need it now. So then all of a sudden you're facing issues with market risk and issues with potential tax events, depending on what they're pulling. If we have another vehicle that we can access in these situations of emergency, that allows you to plan better. It's really sad to me when, I'm a Raymond James client. We have a plan. We have a plan of what's going to happen. I don't want my plan to derail because something comes up. Mm-hmm. Does that make sense?
Yeah, that's the whole point of planning. It's for what you expect and also what you don't expect. Mm-hmm. Yeah, fantastic. So when should someone establish a line of credit? Like how far in advance is appropriate for these kinds of unforeseen things, if you will? Give us like, is there too early? Is there too, obviously there's too late.
There's always a balance, right? But the idea is potentially when you qualify, why when you have this as a piece of your emergency fund. And it's funny because banks sell them to clients like me in my 40s with high debts and this is an emergency fund if you need it. And it doesn't end up being an emergency fund in that scenario. It ends up being a debt vehicle. Mm-hmm. Right. But when we are later in life and we have our home paid off, then it actually is an emergency fund because I have the money to use, say in investments or whatever, but I can use the money off a line of credit strategically, and then pull the other funds when the market makes sense and when I can plan appropriately tax-wise for them.
Okay, so tell us about some of those strategic moments.
Okay, so the one that we're doing a lot right now, we have a ton of baby boomers who are selling, and we don't call it downsizing, we call it right sizing, right? They may be going to a condo or moving the cottage, whatever they're doing. If you've lived your life in a home for 30 years, you probably need to stage it before you sell and do a lot of decluttering. What happens to these people is they sell their home for $1 million, buying a condo for 500, and they think, I don't need a mortgage, which is true. They don't. They're not going to end up with a mortgage over here. They have $1 million home paid off. The issue is that you cannot bridge finance from like a bridge needs two ends to land on. Right? So a bank will not offer you bridge financing. And then it makes it very stressful to have to line up closings and sell and buy on the same day, or they're told that the only option they have is private, like 10 to 15% interest to do that bridge financing to make that sustainable. The better option is for us to set up a line of credit ahead. It's $1 million home. We can set up a line of credit of, $650,000. They can go buy that condo for cash. They can move, they can take their time, they can then declutter, stage, and properly market and list the one they're selling. And when that sale happens, the money that we used for mortgage and bridge gets paid off, and they have a better lifestyle. They've gotten from here to here with a better plan without dipping into savings and without having to access high interest debt products.
I can tell you when you first told me about this, the lights went on, because the biggest pain point of that transaction you just described is the decluttering. The idea that we have to go through, 3 decades of accumulation, of collecting, even though we've had garage sales virtually every summer, somehow this home is still full. And I'm sure I'm not alone. And I think that creates a great deal of angst for our clients. So it's great to have an alternative strategy.
And now it's also a market risk on the real estate side, right? Houses have dipped temporarily. Some of those we're holding as rentals and will sell when the market comes back or when immigration comes back, right? Having it structured this way allows you to do that. If you had a short-term bridge financing with a private lender, you would actually have to sell. And just like pulling funds from investments, like I don't want to see anybody ever have to sell, have to drop their price until they sell. Like that's not ideal. We make a big plan. We plan our whole lives to get where we want to be. We don't want any sort of unforeseen issues to derail those plans.
So what does it cost to carry that line of credit then during that period? How do you structure those usually?
So it depends on the lender, right? We have a bunch of different lenders we do this with. So some of them you guys may be more familiar with, like Scotia, Manulife, TD are typically our go-tos for most of them, depending on how the clients qualify. The Manulife has like a $10 a month fee. The rest of them, there are no carrying costs. You don't spend any money. Oh, HSBC too, we've been doing quite a few with. The others have zero carrying costs. It's really just a setup, because when you set up any sort of secured financing against a home, you're probably going to need an appraisal and legal fees.
Right.
But that's the only cost. And the other advantage too, you learn from my mistakes. We refinanced and restructured our own home in a large line of credit before I went self-employed, because I qualified. I qualified for a lot more than I did when I was incorporated and have really good accountants and financial planners to help me no longer qualify, right?
So similar issue could exist for somebody who retires and perhaps no longer has that paycheck, but has large RSP sources.
Yeah. So the balance really of when to do it is when you qualify, right? So if you're doing it before retirement, that's ideal. If you're doing it after retirement, different lenders have different types of special options we can access depending on how their assets work or how they qualify in equity, or how far they are up the tier in net worth. So there are options, but there may not be as many options as when we can income qualify on the stress test.
Mm-hmm. Okay, that's great. Are there, this is a tricky one, so I'm going to talk about reverse mortgages. So everybody kind of cringes when you say those words, but are there, safe ways of accessing that equity that's in the home, particularly, in retirement scenarios, although I know you're probably going to talk about different age brackets too, but are there safe ways of doing that, accessing the capital? Because we do financial plans for clients. And usually, well, most of them that I've seen, nobody turns to assume that we're going to have a downsizing or a right sizing event, let alone a reverse mortgage baked into the plan. That's never the idea. But the reality is that we have a single largest asset many times with clients, and the house might be worth not $1 million, but 2 or 3. And to not have a reasonably comfortable lifestyle in retirement because you're house rich and cash poor is terrible. So is there a solution that is palatable in the Canadian market?
Yeah. So yeah. Everybody hates Kurt Browning since he started being the spokesperson for CHIP. In Canada, we have 2 reverse mortgage products, right? So Equitable Bank has one, and Home Equity. So the CHIP product, the one that's advertised to everybody online all the time, is the other one. There's also a third option that is Capital One's mortgage lender called Fraction. So it's a relatively new one as well. All 3 have pros and cons. The basics of a reverse mortgage is 2 options, right? So one, you can access a lump sum of money, not make any payments on it, and have like whatever your interest you were supposed to pay back. Instead of paying that on a monthly payment, you pay it back when the mortgage gets paid out. So whether you refinance or you sell, that is when you pay the interest. The other option is people who need to use their home like an ATM. And so then you have access to this amount of money, and you get a paycheck from your house biweekly that acts as a paycheck to allow for living. And there are actually good situations for using these. I know that everybody thinks, oh, they have a terrible name. And I will tell you that we typically will lean towards the Equitable Bank product over the Home Equity product, just because their interest rate structure is something more that we're more comfortable with. It is a different interest rate structure. That being said, Home Equity, because they've been around longer, they can often access more money. So if we need to access more money, situations that we've seen this be really good, people who live in a home and have no cash flow, right? Or in your case, maybe there's people who have a lot of money in investments and the market is down and it makes no sense to pull it out, right? That it's going to cost them more to pull it out, either in a tax event or in a loss, because we need to wait until the market comes back. And accessing those funds, even if they're just temporarily from the home with no monthly cost, is going to help this person out, right? It's a bad analogy, but they always say like the Home Equity product, it really was built for people who owned a house. They owned a house free and clear, and they're living on cat food if they don't get this, right? Because the reality is rent is very expensive. Strategic ways we've seen it used: parents get a reverse mortgage, they gift that money to the kids go buy owner occupied pre-built condos. When the condos are built, there's a huge uptick in the price. They sell them. There is no capital gains because that's the kid's primary residence, and there was no monthly cost to get into that market because there was no monthly payment for the reverse mortgage. Right. So strategically, we see stuff like that happen.
Right.
A lot of the time too, it's just helping kids in terms of like, I'm a parent, I have a house for $2 million. It's totally paid off. I have no interest in selling it. I'm very happy with my life. I have no interest in liquidating my assets or doing anything with my financial savings. And I want to help my kids get into the market earlier. So we talk about basically giving your inheritance early and giving the inheritance out of the house instead of giving it out of other items that are accumulating value, right? And so that's where a reverse mortgage might be the answer. It might be a line of credit with interest-only payments. There's lots of different options. The other example I have is, so that Fraction one is kind of weird because there's no minimum age. So the other 2, no one living in the house can be under 55. So if you have an adult kid living in the basement, you cannot do those programs. Fraction is an interesting one because it has an interesting interest rate structure where you're sharing the cost of the home going up in value. So they'll set a lower and an upper limit, and depending on how much the property goes up in value, they will pay, like you pay that amount of interest. These are great for properties that some of the other lenders won't touch. So student rentals is a big one. A lot of bank lenders cannot touch student rentals, but Fraction is quite happy to do them. Anything that is Airbnb. So we have a cottage where we're Airbnb-ing at, weekly rental. It cash flows really, really well. And there's no qualifying because there's no payments. So I'm able to get a cottage before I qualify for it. I have no monthly payments. They don't care that I'm Airbnb-ing it. So in that case, that structure actually makes financial sense for us.
Okay.
Right.
So this clearly you're not ready for retirement. So there are actual applications for all sorts of individuals.
Yeah. So yeah, they found like a niche in the market where it's often like you have to have a big down payment, which could also be from a line of credit, right? But their market risk is low on it, but they're willing to entertain riskier properties. And because there's no monthly payment, there's no stress test.
Okay.
Right. So when people have exhausted, they have too many properties, or how we pay ourselves as self-employed people no longer allows us to qualify the same way. Right?
Just comment on the US Canada experience, because I remember you mentioning something
because I
about
asked
that.
you this, right? I was so we have essentially two reverse mortgage lenders in Canada. Does anybody know? I don't know if you can put it in, is there a chat, like how many are in the US?
Yeah, if anybody wants to guess, they can just
you want to make a guess?
Put a little comment. Any guesses out there?
So there's 308 in the US. So typically like that gives you a little bit of a peek into how regulated we are in the secured financing world versus the US. And a lot of those really like terrible stories you hear about reverse mortgages, they're coming from our neighbors to the south.
Okay, no, that's reassuring to know, actually, and I know from the few conversations I've had internally here, as soon as I mentioned reverse mortgages, everybody steps back, and rightly so. I mean, you have to do that cautiously. Any kind of lending, quite frankly, you have to be cognizant of what are the implications, and the client needs to understand what
and
what the impact
typically
is.
with all of these situations, like we'll break down all three, right? If somebody says, you know what, I want to access this much money in my house. Okay, here's what secured financing looks like. You can have a reverse mortgage, a line of credit, or a traditional mortgage. And we can look at what the required payments are, what the interest rate structure is, and how we qualify. And then from those three, one is going to be more comfortable for people than others. And it's not always the same.
Right.
Right.
Okay. Yeah. So part of what you do obviously is assess the actual situation of the client and see which of the limitations or structures fit their scenario best.
Yeah. And I mean, that's why we work with 58 different lenders. So we can give them a really broad scenario of a whole bunch of different options.
Yeah. It's not just the big banks, right? Should have been introduced to you, but 2 years ago. But that's all right. We're on the right track now. Do you see problems arise with lenders when there's insurance needed or involved? Like, what kind of scenarios would you see that becomes a concern?
Like life insurance?
Yeah.
Mortgage insurance. So, the saddest thing that we see is people who took like a lender sponsored program, right? So they took mortgage insurance from a particular lender a few years ago, and then they've had some sort of health event and they now can no longer move their mortgage or have any options to restructure their mortgage because that insurance will go away, right? So we're big pushers of independent insurance. And yeah, so I just because in general, that's what happens. People get stuck. The banks know it. They offer them worse renewal rates because they have no option to leave. They're setting themselves up for a position where they get taken advantage of. And I know, like they say it isn't tide selling, but I don't understand how that isn't the case, that like you have this debt and then you have this thing that's forcing you to only keep this debt here and you can't do anything with it. It's not. It's not
who's the beneficiary?
exactly right. So, it's not an ideal scenario. Do you want me to go into what we do, like what we offer typically?
Yeah, for sure. Well, actually, before you do that, I want to comment that, the worst scenario you just commented about someone getting stuck at a bank because of their insurance. I think worse than that is if they actually passed away and the claim isn't honored because for whatever reason the questions weren't answered properly. I know you're more diligent on that front. I know that, but unfortunately, many of your counterparts at the banks are not trained to ask the medical questions appropriately. Is that fair to say?
Yeah. Yeah. Well, I was a health professional, like I was a regulated health professional. So I might understand those questions or ask the right questions a little differently. Right.
Mm-hmm. Yeah.
But yeah, so when we do a mortgage, so let's use an example of TD Bank. When we do a mortgage for TD, mm-hmm. There's an automatic referral form for inside insurance with TD, right? So they will be offered that mortgage insurance from TD Bank. Mm-hmm. We also are required to offer another mortgage insurance product from Manulife. It's slightly better than the Bitcoin because it is independent. It can move from institution to institution, okay. But it is still mortgage insurance. It does insure a declining balance, like all of those things that you've heard about mortgage insurance. What you just touched on, that it is not pre-underwritten is not true. That's people actually incorrectly filling out the paperwork. Right. So if you fill it out a certain way, it will automatically trigger an underwriting. Mm-hmm. But what we've been able to do, so I have a couple people that I work really closely with at Raymond James, and we've been able to find a lot more life insurance leads for our clients, and they're a lot better leads for life insurance for you guys. So if you know mortgage brokers that you're working with, it might be worth having a conversation with them. Typically when we work with the clients, we are saying, here's mortgage insurance. I don't sell insurance. I don't know about insurance. This is why I have Greg in my life. I don't know. Right. But what I can tell you is you're responsible to this debt. And if it's $500,000 and the two of you are both required to have an income and be present to qualify for this, my concern is that you have to have something in place. It does not have to be this. We can set this up for now. It's free for the first 30 days, covered by a money back guarantee for the second 30. And in those 30 days, what I need you to do is talk to a very qualified life insurance person. What happens is that those referrals to our financial planners, to our life insurance people, they actually call them back because they have a ticking time bomb of I have to have something set up within this 30 days. They also already know that they have to have life insurance. You don't have to sell them on the idea that they need this. They are aware that they have taken on this debt and being responsible to each other. They need to have some type of insurance somewhere in place that is going to cover that. And then from there, our insurance people are able to compare what type of coverage and price. And it's often the case that they can find better products for them, but they do turn out to be better leads if we sign them up for those products.
Have you ever encountered a situation where somebody is uninsurable and therefore can't get the loan because there's a requirement of insurance? I mean, I don't know if that ever happens.
I haven't really seen. So even you're not required to have life insurance as you have to have home, you have to have fire insurance in order to get a house. You don't have to have life insurance. Okay. My concern is, what happens if you don't? And it's not a concern of as a mortgage broker, it's a concern as a human. If you guys need both of your incomes and one of you is no longer here, how does that other person keep that debt? And different lenders treat that differently. So we have seen lenders start the foreclosure process the day after somebody loses a spouse. It is terrible. Yeah. Other lenders will work with the clients, but you don't really know what you're going to get. People need to have a proper financial plan. Mm-hmm. And that includes insurance.
Yeah, absolutely. Okay, well, we've covered a lot of ground. Is there anything else you want to throw in there as final comments? Any lending strategies perhaps we should come back to in the future for another session? Let's tease us with something here.
Well, I just think a lot of the time when you have clients coming to you because what we see all day, every day in the market right now is helping their kids. There is not a one size fits all way to do that. Typically, from most kind of mortgage professionals, they'll be offered co-signing. That is not always the best strategy. And that's where some of these like lines of credit, like we've had parents who, instead of co-signing, they've been able to just pay off their kids' debt with a line of credit, and then that allows the kids to qualify. The co-signing piece is a bit nerve-wracking sometimes, especially if your clients want to do something in the future. They want to buy a cottage, they want to downsize, upsize, whatever. So I really think when it comes to that, you'll see a lot of clients come to you and say, oh, I have to do this to give my kids a down payment, or I have to do this because I need to co-sign for them. There's a lot of different options out there that they really should be talking to a professional about that knows what they're doing.
Excellent. That's fantastic.
That makes sense.
Okay. Yeah, I think we'd like to open up the lines now for any questions that might be out there. So Diana, if you don't mind.
Yeah, I'm just working on it right now.
Perfect.
I see names popping up.
Yeah.
Do they have faces too? Oh, exciting.
Well, I hope that was useful and helpful for many of you. I know in my few conversations with Denise in the past few weeks, I've learned a great deal about what I should have done and also what I may do in the future. Very practical aspects to lending that we take for granted. I have gone to banks all my life for whatever reason, and would probably have continued to do that if she hadn't intervened. But I certainly will be engaging her in my next lending strategy.
All the lines have been unmuted. You guys are all free to ask your questions.
Perfect. Who's got a child they want to finance a home for?
Or in my case, a sister. My kids aren't old enough, so I get to help my sister instead. And even with the co-signing piece, right? There's strategic things you can do to protect yourself and protect your co-signee as well.
And on that idea of, helping out children, one of the things obviously we always, most of our advisors would say is to make sure there's a lending arrangement between yourself and the child to make sure in case there's a marital breakdown in the future, those funds are not part of the matrimonial home.
Right.
But that can be structured within the lending arrangement that you're suggesting too, I guess.
It can, yeah. So the percentage of ownership, trust agreements can help. I have things in my sister's will about my participation in her home. So it's quite creative what you can do if you are looking at the bigger picture.
Perfect. Okay, I don't think we have any questions, except I see Wilson is unmuted. Did you want to jump in there, Wilson?
Thanks, Greg. Hi, Denise.
Yeah.
Great talk. And just a quick question. If someone was coming to you right now with an option of either a fixed mortgage or a variable rate mortgage, what would you recommend?
So it depends on the client, right? Like there are best fit products for everyone, but let's say your ideal client is somebody who they're close to retirement, they might move in the future. I would say more importantly than the rate is going to be the exit strategy. That variable rate mortgage is going to be significantly cheaper to break, especially depending on which lending institution they are working with. The highest fixed rate penalty I've seen in the last couple of years was $54,000 from RBC. And if you sold your home, do you want to give the bank $54,000 or do you want to give them $2,500? I know which one I want to do. On top of that, right now, like with the volatility in the market and how interesting our economy is, there is the potential for, recession sometime within the next 5 years. There is potential for what's happening in Russia and Ukraine to potentially impact our interest rates. Either of those things should have interest rates in a normal environment decrease. So right now, most of our clients are taking variable rate mortgages with the potential to lock in the future should we see decreases during their term. And with the variable rate, a lot of my clients right now, we're taking fixed payment variables. So if we look at, TD and Manulife, TD has a fixed payment variable. Manulife has adjustable mortgage. So as the Bank of Canada adjusts, the payment changes with Manulife, whereas TD, the amount of principal and interest changes inside the payment. So even people who were only comfortable with a fixed rate mortgage, sometimes they don't want a fixed rate mortgage, they want a fixed payment. That those products with like HSBC, TD, Desjardins, and Meridian are typically where we're going with those. They all have fixed payments.
That's a great distinction. Yeah.
And depending on some of them too, like TD will allow us to lock in at the 3-year rate instead of the 5-year rate. So if we think that there's going to be a situation where we'll lock in, that could potentially access better interest rates than other lenders when it is time to lock in.
With variable rate mortgages and fixed rate mortgages, are prepayment terms better for fixed rate mortgages?
No, it's
the other way around.
It's specific to the bank.
Okay.
Right. So certain banks have 10%, certain banks have 20%, 15%, like they're all over the map in terms of limits. I think the Manulife has about the best structure right now because they're 20%, but then they have some other double up stuff that kind of puts them at 25% if they're looking at paying their mortgage off. My argument would be, do we really want to do that? Like, I have lots of mortgages and every year I go to my accountant and say like, maybe I should pay off my mortgage this year. And he's like, do you see how much your financial advisor is making for you? Do you see how little your mortgage costs? Like, are you stupid? And it's not like, you know, it really doesn't make sense to pay off something that is a low interest rate when we're making more interest with the money somewhere else, right? So to me, it's an opportunity cost question of your money as well.
Great, thank you.
Right? Like as a financial advisor, do you want them paying off their mortgage or do you want them giving it to you to make more money with it?
Correct, yeah, depending on risk.
Yeah, as long as they're able to service that debt, obviously. Yeah, I know Wilson's concern is not to over leverage, right?
Yeah, and risk and rate, right? And like we've been in a situation where rates are like money has been free for so long. As we're going back to what a normal world should look like, I mean, that conversation might be different moving forward, right?
Yeah, that's great. Thank you.
Perfect. Anybody else? All right, I think we've covered what we wanted to do. And thank you very much, Denise, for joining us today and for all of you who dialed in. We will send this recording out to you. And if you'd like to share it with your clients, obviously you're welcome to do that. Thank you all. See you soon.
Thanks, Greg.